retrospect, but by argument in favour of another rise. We knew we were wrong, but tried to convince ourselves that we were right. Baruch's assertion that, as a group, the stock market speculators of 1929 displayed a crowd mentality fits well with the analysis of Freud and others. The crowd mentality may be seen to have its source on the floor of the New York Stock Exchange. Like the war drum of the African tribes, the ticker, excitedly clattering out the latest stock prices to brokers' offices, spread the spirit of the crowd from further afield. During the normally torpid summer months, an actual crowd, estimated at 10,000 persons, filled New York's financial district, lending a carnivalistic atmosphere to the last days of the bull market. Informal speculative groups congregated everywhere, while the radio joined those living in isolated communities to the bull crowd. This crowd, led by men such as Charles Mitchell and Mike Meehan, gained cohesion from the New Era ideology and a collective faith in rising stock prices. In the face of minor stock market panics, in June and December 1928, and later in March 1929, the bull forces succeeded in regrouping. They came out stronger for their trials, until the point was reached when speculators became deaf to warnings they did not wish to hear, and developed a belief in their own invincibility. Instead of reasoning, they thrived on the countless rumours of fabulous wealth gained in the stock market by valets, chauffeurs, cattlemen, actresses, farmers' wives, and so on. In Only Yesterday, Frederick Lewis Allen described the trance into which the average American had fallen by the summer of 1929. He visioned an America set free from poverty and toil. He saw a magical order built on the new science and the new prosperity. Roads swarming with millions upon millions of automobiles, airplanes darkening the skies, lines of high-tension wire carrying from hilltop to hilltop the power to give life to 1,000 labour-saving machines, skyscrapers thrusting above one-time villages, vast cities rising in great geometrical masses of stone and concrete, and roaring with perfectly mechanized traffic, and smartly dressed men and women spending with the money they had won by being far-sighted enough to foresee, way back in 1929, what was going to happen. Nemesis. According to Festinger, a group will maintain a state of cognitive dissonance until the pain exceeds the rewards. In stock market terms, this might be seen as the moment when the fear of loss outweighs the greed for gain. That point was reached on the 3rd of September 1929, when the Dow Jones reached its year high. The following day, at the annual National Business Conference, an investment advisor named Roger Babson forecast an imminent stock market crash. He predicted that factories will shut down, men will be thrown out of work, the vicious circle will get in full swing, and the result will be a serious business depression. The pronouncement elicited a savage response from the apostles of the new era. No pun was too corny. One paper dubbed Babson the prophet of loss. Another suggested that he was suffering from an attack of Babson-mindedness. Stockbrokers pointed out that Babson had made the same forecast in the 2 previous years. Professor Irving Fisher emerged from his ivory tower to justify the current stock price levels and deny the likelihood of a crash. Yet on this occasion the market appeared to heed Babson's warnings and weakened sharply. The new era invocations had suddenly lost their potency. Although investment trusts issued a record $600 million worth of new securities in September, the stock market remained weak throughout the month. It became increasingly receptive to bad news. In the middle of September, the information was received from London that the business empire of Clarence Hattrey had collapsed amidst revelations of fraud. The Bank of England reacted by raising interest rates, causing British investors to start selling their American investments and repatriating their capital. On the 4th of October, Alfred Sloan, the head of General Motors, observing a sudden dip in car sales, announced that the end of expansion was at hand. A week later, the Massachusetts Department of Public Utilities denied the request of the Boston Edison Company to split its stock, 4 shares for 1, on the grounds that speculators had already driven its share price above intrinsic value. Rumours surfaced that bear pools, led by the renowned speculator Jesse Livermore, were preparing to drive the market down with short sales. Livermore received a mailbag of death threats and issued a public statement denying the rumour. At the beginning of September, Winston Churchill had arrived in the United States on a lecture tour. The former Chancellor of the Exchequer was not only the descendant of speculators, Sarah, Duchess of Marlborough, and Leonard Jerome, he was also connected with the leading players in the current bull market. In New York he stayed with Percy Rockefeller, a member of numerous stock pools, and dined with Bernard Baruch. Churchill enlivened his visit by purchasing shares on margin, using as capital £20,000 he had recently earned from journalism and lecture fees. On Thursday the 24th of October, Churchill was walking down Wall Street when a stranger invited him to enter the visitors' gallery of the New York Stock Exchange. 2 months earlier, James Walker, the mayor of New York, had visited the same place to witness what he called the 8th wonder of the world, the continuing bull market on the big board. A rather different spectacle confronted Churchill that day, a day known thereafter as Black Thursday. The panic that unfolded before his eyes had no palpable cause. Unlike former stock market panics, it was not preceded by tightness in the money market. No banking, brokerage, or industrial failures served as a trigger, and yet panic there was. Within half an hour of opening, many stocks were dropping 10 points between trades. Several stocks hit air pockets when no bid was offered. By 1 o'clock, the ticker was running an hour and a half late. There was a surreal quality to events. Churchill had expected to see pandemonium, but the rules of the exchange precluded members from running or shouting. So there they were, walking to and fro like a slow-motion picture of a disturbed ant-heap, offering each other enormous blocks of securities at 1/3 of their old prices and half their present value, and for many minutes together finding no one strong enough to pick up the sure fortunes they were compelled to offer. A measure of calm was restored after leading bankers met at the offices of J.P. Morgan and supplied funds to buy shares and stabilize the market. Although the stock averages had not fallen greatly by the close of trading, the Dow Jones closed down only 6 points at 299. Nearly 13 million shares had changed hands on the New York Stock Exchange, triple the normal daily turnover, and more than double the previous record. Black Thursday marked only the beginning of the disorderly liquidation of financial assets inflated by the preceding bubble. The following 2 trading days were relatively quiet. Over the weekend, staff at the brokerage houses remained at their desks, clearing up the backlog of paperwork and calculating the margin calls to be sent out by telegram to their clients. On Monday, the 28th of October, disaster struck. The Dow Jones Industrial Average fell 38 points to 260, the largest drop on record. The ticker ran 3 hours late at closing. Throughout the day, foreign and corporate lenders to the call market scrambled to withdraw their loans. From the moment it opened on Tuesday, the 29th of October, the stock market was deluged by a further wave of sale orders, as margin calls forced speculators to dispose of their stocks. Gone was the composure witnessed by Churchill a few days earlier. On the floor of the exchange, a broker grabbed a messenger by his hair, another fled the floor screaming like a madman, jackets were torn, collars dislodged, and clerks in their frenzy lashed out at each other. The panic worsened after the technology upon which the market had become dependent collapsed. The transatlantic cable broke, the ticker stopped running, telephone lines became clogged with inquiries, and the telegraph system was unable to cope with the volume of brokers' margin calls sent out across the nation. In New York, Western Union was forced to hire a fleet of taxis to deliver its telegrams. When the market closed, the ticker carried on clattering its dismal message for 2 hours. The Dow Jones Industrials were down 30 points at 230, on a massive turnover of 16.5 million shares. They called it the day of the millionaire's slaughter. On Black Tuesday, the glamour stocks of the bull market suffered the worst damage. Radio Corporation of America, which on Monday had shed $19, collapsed from 40.25 to 26 in the first 2 hours of trading, at which point it was down over 75% from its peak. The Goldman Sachs Trading Company opened at 60 and closed at 35. Blue Ridge, its affiliated investment trust, which a few weeks earlier was selling for 24, dropped from 10 to 3. And the United Corporation, J.P. Morgan's giant utility, went from 26 to 19.30. Bank stocks were slaughtered. The First National Bank of New York declined from $5,200 to $1,600, while National City sank from $455 to $300, despite a rearguard action from Charles Mitchell, who personally borrowed $12 million to support the stock. The Hollywood favorites, Paramount, Fox, and Warner Brothers, were also hit hard. For many stocks there was simply no bid. A messenger boy was reported to have picked up a parcel of White Sewing Machine Company, which had traded earlier in the day at 48 and closed the previous day at 11 1/8, for $1 a share. The slide into depression. America faced its stock market ordeal with a sense of humor. The market steadied the day after Black Tuesday, when John D. Rockefeller Sr. announced that he and his son were purchasing sound common stocks. "Sure," reported Eddie Cantor from the Broadway Footlights, himself down a reported $1 million. Who else had any money left? It was Cantor who gave publicity to the suicide legends of two speculators leaping from a bridge holding hands because they shared a joint account, and of hotel reception clerks asking new arrivals whether they came to sleep or to jump. He also observed that since the crash, women's hemlines had come down. The jazz age, according to Scott Fitzgerald, had leapt to a spectacular death. More austere times were around the corner. Although stocks continued to slide until the middle of November, Hoover's administration acted promptly to mitigate the fallout from the crash. The president's public pronouncements were consistently upbeat. He convened business leaders and urged them to maintain wages in order to sustain demand. Private and public organizations were asked to bring forward their construction plans, and Treasury Secretary Mellon announced a small tax cut in November. The banking authorities also acted speedily. On the 31st of October, the Federal Reserve reduced the discount rate to 5%, followed by a further reduction of 0.5% 2 weeks later. The New York Federal Reserve Bank oversaw a massive shift in the call loan market, as outstanding margin loans dropped by 50% between September and November. Foreign and corporate lenders continued to withdraw their funds from the call loan market and were replaced by the New York banks, which maintained low rates on loans and reduced margin requirements to 25%. There were no significant banking or brokerage failures in the immediate aftermath of the crash, apart from the Industrial Bank of Flint, Michigan, which was forced to close its doors after it was discovered that a cabal of employees had stolen $3.5 million and lost it in the stock market. American corporations also did their best to steady nerves. The day after Black Tuesday, U.S. Steel and several other companies announced increased dividends. Samuel Rosenwald of Sears Roebuck and Samuel Insull declared they would guarantee their employees' margin accounts. When General Motors announced an extra dividend on the 14th of November, the news was greeted jubilantly, and the Dow Jones stepped off its low of 198 and rose by nearly 25% over the next few days. Optimism was quick to resurface. On the day the market turned, Bernard Baruch cabled Churchill to inform him that the financial crisis was over, although this was of little comfort to the future Prime Minister, who lost more than £10,000, roughly £300,000 at today's values, in the crash, and was obliged to live frugally for the next few years. Baruch's was a conventional opinion shared by many of the smaller market players, who believed the crash presented them with yet another buying opportunity. The news was mostly positive. Turnover in the stock market was lively at 5 to 6 million shares a day. Many corporations announced record profits for the previous year, and mergers in banking and utilities continued, as did the property boom. People took comfort in the fact that the major banks appeared well capitalized. In New York, J. Raskob continued with his plans for the 100-story Empire State Building, which he described as a symbol for a land which reached for the sky with its feet on the ground. In his ambition to build the world's tallest building, Raskob faced competition from his fellow speculator Walter Chrysler, who was building his own 1,146-foot-high skyscraper. Meanwhile, William Crapo Durant busied himself with new stock pools. In March 1930, President Hoover announced that the worst effects of the crash upon employment will have passed during the next 60 days. The following month, the Dow Jones broke through the 300 barrier, up nearly 50% from its post-crash low. Yet the Suckers' Rally, as it was later called, came to an end in the spring of 1930, and the market resumed its downward course until the summer of 1932, when the Dow reached a low of 41.88 on a turnover of under 400,000 shares. In the intervening period, the country's gross national product had fallen by 60% from its 1929 level, and unemployment had risen to 12.5 million. Over a third of the non-agricultural workforce was unemployed. As the nation sank into depression, the apotheosis of the businessman came to an end. In March 1932, Ivar Kruger, the Swedish match king, committed suicide in a Paris hotel after his business empire collapsed under the weight of debts and the discovery of Kruger's own frauds. The following month, Samuel Insull's Middle West Utilities went into bankruptcy, and Insull fled the country. He later returned to face trial and was acquitted of fraud. The directors of the Goldman Sachs Trading Corporation were put on trial for wasting the company's assets. Charles Mitchell was forced to resign from the National City Bank, whose share price fell from 4% of its 1929 peak, and in 1934 he was tried for income tax evasion. William Crapo Durant was sold out by his brokers in late 1930 and declared bankrupt in 1936 with debts of nearly $1 million. He found temporary employment washing dishes in a New Jersey restaurant. Jesse Livermore, who had made his first fortune in Wall Street during the 1907 panic, lost an estimated $32 million before being declared bankrupt in March 1934. 6 years later, Livermore blew his brains out in the washroom of the Sherry Netherland Hotel in New York. When the market touched bottom in 1932, Radio Corporation of America was selling for $2.50 a share, down from $114 3 years earlier. Mike Meehan, the radio specialist on the New York Stock Exchange, was reported to have lost $40 million in the crash. His seats on the exchange were put up for sale, and his brokerage offices on the transatlantic liners were closed down. In 1936, Meehan entered a lunatic asylum. Popular history holds these men, along with their countless followers, responsible for the Great Depression. At his inauguration in March 1933, Franklin Delano Roosevelt addressed the nation. "Plenty is at our doorstep, but a generous use of it languishes in the very sight of the supply. Primarily, this is because rulers of the exchange of mankind's goods have failed through their own stubbornness and their own incompetence, have admitted their failure, and have abdicated. Practices of the unscrupulous money changers stand indicted in the court of public opinion, rejected by the hearts and minds of men. True, they have tried, but their efforts have been cast in the pattern of an outworn tradition. Faced by the failure of credit, they have proposed only lending of more money. Stripped of the lure of profit by which to induce our people to follow false leadership, they have resorted to exhortations, pleading tearfully to restore confidence. They know only the rules of a generation of self-seekers. They have no vision, and when there is no vision, the people perish. The money changers have fled from their high seats in the temple of our civilization. We may now restore that temple to the ancient truths. The measure of the restoration lies in the extent to which we apply social values more noble than mere monetary profit. Had Roosevelt referred to speculators rather than money changers, his meaning might have been clearer. But as it was a time for divine retribution, with the new president playing the role of a wrathful Christ, the biblical money changers had a more suitable ring. Less than a year earlier, in the summer of 1932, Roosevelt had staked his claim to presidential office on the failure of economic individualism and the responsibility of Wall Street for the Depression. Hoover was stigmatized as an unfeeling, laissez-faire, new-era Republican, an attack that unfairly overlooked Hoover's unceasing, if futile, attempt to revive the economy. In the spring of 1932, the Senate Committee on Banking and Currency opened its investigation into the operations of Wall Street during the 1920s. Ferdinand Pecora, the Sicilian-born head counsel for the investigation, interrogated the prominent financiers of the 1920s and mercilessly exposed their shortcomings. Tales of pools, market manipulation, preferential treatment for insiders, shoddy treatment of outsiders, tax evasion and excessive remuneration were revealed to the public at the moment of its greatest distress. It was Pecora's conclusion that the exchange had become a glorified casino where the odds were heavily weighted against the eager outsiders. During Roosevelt's first administration, a series of measures were initiated to restrict the freedom under which speculators had formerly operated. Investment and commercial banking were separated by the Glass-Steagall Act of 1933. In future, the capital of commercial banks and their ability to lend would no longer fluctuate with the rise and fall of the stock market, and their customers would no longer be pushed second-rate securities. A year later, the Securities Exchange Act became law. Stock market pools, insider trading, and market manipulation were proscribed. The Federal Reserve was given the power to restrict margin loans, which were limited to a maximum of 50% of the collateral value of shares. The Securities and Exchange Commission was established to police the capital markets and prevent unnecessary, unwise, and destructive speculation. In a controversial move, Roosevelt appointed Joseph Kennedy, a member of numerous stock pools, as its first chairman. Bear speculators, whose short selling was blamed by nearly everyone, including Hoover, for the collapse in market confidence, were restricted by the introduction of the uptick rule, which permitted short sales only after a stock had risen on its last trade. The politics of Roosevelt's New Deal rejected the freewheeling individualism of the 1920s and replaced it with governmental direction in economic affairs. In place of market forces came federal welfare, housing and work programs, bank deposit insurance, prices and income policies, minimum wage legislation, and a number of other measures. Speculation, whether in stocks, bonds, land, or commodities, was no longer to play such a key role in economic life. These largely ad hoc measures were provided with an intellectual framework by the publication of Keynes's The General Theory of Employment, Interest and Money in 1936. Keynes attacked the earlier prominence given to speculators and the stock market in the allocation of capital resources. He asserted that there is no clear evidence from recent experience that the investment policy which is socially advantageous coincides with that which is most profitable. In perhaps the most quoted passage from the book, Keynes wrote, "Speculators may do no harm as bubbles on a steady stream of enterprise, but the position is serious when enterprise becomes a bubble on a whirlpool of speculation. When the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done." In support of this statement, Keynes drew his readers' attention to the recent history of Wall Street, whose success in directing new investment towards the most profitable channels cannot be claimed as one of the outstanding triumphs of laissez-faire capitalism. As a cure for the evil of speculation, he suggested a punitive capital gains tax on stock market transactions in order to force investors to take a long-term view. For the state, a body free from the animal spirits that characterize the speculator and thus able to consider social advantages rather than mere profit, he foresaw a greater role as an investor. In Europe, at least, the age of nationalization beckoned. Not all economists and historians have been convinced by this scapegoating of speculators in the wake of the crash. Milton Friedman, the monetarist economist, has claimed that the stock market crash in 1929 was a momentous event, but it did not produce the Great Depression, and it was not a major factor in the Depression's severity. Instead, Friedman and his co-author Anna Schwartz, in their Monetary History of the United States, blamed the Federal Reserve for allowing an overly restrictive monetary policy which caused the stock of money to decline by a third between August 1929 and March 1933. According to Friedman and Schwartz, the Depression deepened after the first banking crisis in the autumn of 1930, when the Bank of the United States was, in their view, unnecessarily allowed to fail. This analysis appears to play down the degree to which the early major banking failures of both the Detroit banks and the Bank of the United States were largely due to their exposure to declining property prices and stock market losses at their securities affiliates. It was these failures which, in turn, triggered the general banking crisis. The experience of the Japanese banks after the bubble economy of the 1980s, considered in Chapter 9, reinforces the impression that the banking crisis of 1932 was the direct result of the preceding era of speculation. Charles Kindleberger, viewing events from a more international perspective, saw the Depression as the result of declining commodity prices due to endemic overproduction since the First World War, and the failure of the United States to adopt the role as international lender of the last resort to European nations. In place of loans, the Hoover administration introduced tariffs, which led swiftly to retaliation, followed by competitive currency devaluations across the world. Other economic historians have blamed the Depression on the rigidities caused by the gold exchange standard, which operated during the 1920s and early 1930s. Murray Rothbard, an American economist, has argued that the policies of Herbert Hoover were to blame for the Great Depression, not for being too laissez-faire, as Roosevelt asserted, but because they were insufficiently so. Hoover's essential failure, Rothbard claimed, was to ignore Treasury Secretary Mellon's advice that the crash would be beneficial if it were allowed, in his oft-quoted phrase, to liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. In other words, Mellon suggested that the market should be left to fall until it found its own clearing level, when demand would return and the economy revive. Instead, Hoover's policies prevented wages from falling at a time when asset and commodity prices were declining. This served to increase unemployment and reduce the returns on capital, thus preventing reinvestment. Rothbard concluded that the guilt of the Great Depression must be lifted from the shoulders of the free market economy and placed where it properly belongs, at the doors of politicians, bureaucrats, and the mass of enlightened economists. As if this were not enough, Herbert Hoover blamed Franklin Roosevelt and the Democrats for deepening the public's fear and distrust throughout the election campaign of 1932, and for failing to cooperate with the outgoing administration's relief measures. Hoover has received recent support from Barry Wigmore in The Crash and Its Aftermath, who claimed that Roosevelt's speeches in 1932 and his refusal to guarantee the gold standard precipitated the public's hoarding of money and brought on the banking crisis of early 1933. Wigmore concludes that Roosevelt, as much as anyone, raised the crash to its symbolic position as the cause of the Depression. The relationship between the crash and the Great Depression is one of the most keenly debated issues in economic history. Because the debate is politically charged, concerning whether markets should ultimately be controlled by governments or left to their own devices, it will never be resolved to the satisfaction of all parties. As Roosevelt showed, political capital could be earned by insinuating a causal link between the crash and the economic crisis. Subsequently, that link was used to justify the policies of the New Deal. A generation later, Professor Friedman's assertion that the stock market collapse did not cause the banking crisis or lead to the Great Depression was taken up fervidly by the Reagan Republicans, who wished to overturn Roosevelt's legacy. We find from the record of contemporaries that the crash and the subsequent decline in asset values had a profound effect on people's expectations. In an essay entitled Echoes from the Jazz Age, first published in Scribner's Magazine in November 1931, Scott Fitzgerald claimed that the Jazz Age ended with the crash. The most expensive orgy in history was over because the utter confidence which was its essential prop received an enormous jolt, and it didn't take long for the flimsy structure to settle earthward. It was borrowed time, anyhow, the whole upper tenth of the nation living with the insouciance of Grand Dukes and the casualness of call girls. As the market crashed, the happy vision of the future dispelled, leaving the American people uncertain and unprepared for the difficult economic conditions of the early 1930s. In Only Yesterday, Frederick Lewis Allen saw the Depression as a profound psychological reaction from the exuberance of 1929. Prosperity is more than an economic condition, it is a state of mind. The big bull market had been more than the climax of a cycle in American mass thinking and mass emotion. There was hardly a man or a woman in the country whose attitude toward life had not been affected by it in some degree, and was not now affected by the sudden and brutal shattering of hope. With the big bull market gone and prosperity going, Americans were soon to find themselves living in an altered world, which called for new adjustments, new ideas, new habits of thought, and a new order of values. During the late 1920s, American economic reality had become dependent on a precarious vision of the future. After the crash, when every tenet of the new era philosophy was shown to be false, Americans lost that confidence in the future which is necessary for the successful operation of the economic system. As George Orwell observed, poverty annihilates the future. When asset values declined, causing havoc in the banking system, a psychology of fear replaced the optimism of the previous decade. Perhaps, as some claimed, the Roaring Twenties were morally degenerate years deserving of a biblical visitation. But they were also a period when people exhibited a capacity for dreaming, a faith in the future, an entrepreneurial appetite for risk, and a belief in individual freedom. These profoundly American traits took a severe knocking in October 1929, and appeared to be extinguished during the Great Depression. They would return. Postscript: The New Paradigm, a 1920s revival on Wall Street. During the 1990s, the United States experienced a bull market remarkably similar to that of the 1920s. The Dow Jones Industrial Average rose from a low of 2,365 in 1990 to reach 10,000 in March 1999, a gain of more than 320%. As in the 1920s, the recent rise in speculation was initially stimulated by low interest rates set by the Federal Reserve during the early 1990s. The rapid expansion of information technology provided the stimulus to economic growth in the 1990s, just as the motor car did in the 1920s. The profitability of American corporations was similarly enhanced by the inability of unions to push through real wage increases. Once again, workers maintained their consumption by purchasing goods on credit, an indulgence which led 1 million Americans to declare themselves bankrupt in 1997. Although the presidency was held by a Democrat throughout the 1990s bull market, the Republican control of Congress and the shift of the new Democrats to the political center have meant that the policies emanating from the White House resembled more closely those of Calvin Coolidge than those of Franklin Roosevelt. Lax enforcement of antitrust laws has facilitated a series of corporate mergers on a far greater scale than that experienced in the 1920s. During the same period, the separation of investment and commercial banking enshrined in the Glass-Steagall Act of 1933 was under siege. By the middle of the 1990s, the cult of equity, a slight rephrasing of the 1920s cult of common stocks, was clearly in evidence. Approximately 50 million Americans held shares, and the stock market was being discussed everywhere, in bars, golf courses, clubs, gyms, beauty salons, and on television chat shows. Mutual funds were featured on the front cover of Playboy magazine. A primary school in Florida launched a new course entitled Material Wealth and the Stock Market. Within 6 months, the children's model portfolios were up by a third, and they all dreamed of becoming stockbrokers. An investment seminar held in Las Vegas by Louis Rukeyser, the presenter of Wall Street Week on public television, attracted nearly 10,000 people. On his show, Rukeyser hailed investors who maintained the faith. The business channel CNBC drew the fastest-growing audience in America. By 1998, there were over 37,000 investment clubs, up from 6,000 at the beginning of the decade, where amateur stock market players gathered to exchange ideas and swap tips. The explosion of investment trusts during the 1920s was exceeded by the rapid growth of mutual funds in the 1990s. Between 1990 and the first quarter of 1998, equity mutual funds attracted over $1 trillion from American investors. In 1990, there were 1,100 mutual funds in operation. 7 years later, nearly 6,000 mutual funds competed to attract investors' capital. Inflows into mutual funds became the mainstay of the bull market. During 1996, a total of $221.6 billion was invested in U.S. equity funds, with a further $231 billion invested the following year. By the end of 1997, the total assets of U.S. mutual funds had risen to $4.2 trillion, a sum roughly equal to the assets of the banking system. Just as in the 1920s, it was argued that private investment in shares by people saving for retirement would provide a long-term support for the stock market. The revival of faith in the stock market was accompanied by the observation that shares had provided superior investment returns compared to bonds since the 1950s. In April 1966, on the occasion of the 100th anniversary of the establishment of the Dow Jones Industrial Average, the Wall Street Journal reported that in 98% of all 20-year periods since 1925, shares had outperformed bonds. This was, of course, exactly the same message that E. L. Smith popularized in the 1920s. One fund manager described the stock market as a very nice casino in which everyone can get to go home with a return of 10% after the house take. Such a sentiment appeared to echo the claim of Will Payne, who argued, in the January 1929 issue of World's Work, that the difference between gambling and investment was that while a gambler could only profit at the expense of someone else, with stock market investment everyone was a winner. The belief that the stock market would invariably produce the greatest returns led investors to purchase shares regardless of price. The market's price-earning ratio rose to a historic high of more than 28 times earnings in the spring of 1998. The only financial risk in the 1990s bull market was to leave money idle in a bank account, while the stock market notched up gains of over 20% year after year. The rising market inflated investors' expectations to irrational levels. On the eve of the market correction in October 1997, a broker's poll found mutual fund investors expecting an average 34% annual return over the next 10 years, an expectation which, if realized, would send the Dow Jones to 151,000 and the total U.S. stock market capitalization to 1,500% of national income. The American investor of the 1990s had many qualities in common with his 1920s predecessor. Although the use of leverage was less conspicuous than in the 1920s, margin debt increased from around $30 billion in 1990 to $154 billion in July 1998. A number of ploys were used to skirt the Federal Reserve's restriction on margin loans to 50% of the collateral value of the shares. Speculators slowed down the repayments of their mortgages or took out home equity loans to finance stock purchases. They bought shares on credit cards and availed themselves of the futures markets, where no margin regulations were applied. The Chicago Mercantile Exchange obligingly created a mini S&P contract that required a deposit of only $3,000. Several finance companies used the futures markets to hedge loans they made to private investors. James Grant, editor of Grant's Interest Rate Observer, discovered one company, First Security Capital of San Diego, providing 90% loan-to-value margin loans with a minimum loan of $100,000. Since First Security was neither a bank nor a broker-dealer, its margin loans were not controlled by the Federal Reserve. The 1990s American investor, just like his earlier counterpart, convinced himself that he was buying shares for the long term rather than speculating for quick profits. "Buy and hold," observed James Grant, have replaced "I love you" as the most popular 3 words in the English language. In both periods, investors saw each market decline as an opportunity to buy into the dip. As a result, every downturn was quickly reversed, supplying the bull market with an aura of invincibility. This tendency reached its apogee on Monday, the 27th of October 1997, when the Dow Jones fell by over 7% on fears generated by the collapse of the Asian economies a couple of months earlier. Employing the same language as Herbert Hoover used after the 1929 crash, U.S. Treasury Secretary Robert Rubin reassured investors that the fundamentals of the American economy were sound. On Tuesday, long lines were seen outside New York brokers' offices. However, they were queuing to buy more shares rather than sell. That day, the market rose by more than 5% on a record New York Stock Exchange turnover of 1.2 billion shares. Within 6 months, the Dow had climbed by over a quarter from its low of the 27th of October, and the S&P 500 index was up over 50% on the last 12 months. The 1990s bull market was accompanied by the reappearance of a new era ideology similar to that of the 1920s. Known as the new paradigm, or the Goldilocks economy, like the porridge in the fairy tale, it was neither too hot nor too cold. The theory suggested that the control of inflation by the Federal Reserve, the decline in the federal deficit, the opening of global markets, the restructuring of corporate America, and the widespread use of information technology to control inventory stock levels had combined to do away with the business cycle. Point for point, this was a reiteration of the New Era philosophy of Irving Fisher's day. The new paradigm made its first appearance in the middle of the decade. In late 1995, a Salomon Brothers analyst named David Shulman produced a report entitled 1996 Stock Market Bubble or Paradigm Shift, in which he argued that the decline in inflation had caused the third fundamental shift in stock market valuation in 40 years. Abby Joseph Cohen, chief investment strategist for Goldman Sachs, became the best-known advocate of the new paradigm, the Irving Fisher of her day. Appearing frequently on television shows, on magazine covers, and in the newspapers, she was hailed as the guru who had first identified the outlines of the latest new era. Ralph Acampora, chief technician of Prudential Securities, was another prominent spokesman for the new paradigm. "It makes all the sense in the world that our stock market should go up, because we have more confidence in our way of life," he told Fortune magazine in August 1997. As the rising stock market served as a palliative to the scandals that dogged Clinton's presidency, the new paradigm was warmly received in Washington. In February 1997, a member of the Clinton administration was quoted in the Herald Tribune as saying that there is no inevitable economic cycle, and we have found in a recent study by the Council of Economic Advisers that cycles don't die of old age. A month later, President Clinton himself was moved to observe that the US economy was performing so well that the concept of the business cycle may have been effectively repealed. In June 1997, the New Republic reported, under the headline "Bust Busting: The End of Economic History," that top officials at the Treasury Department believe that, with the proper mix of policies and the absence of external shocks, the United States can prolong the current expansion indefinitely. The attitude of Alan Greenspan, the Federal Reserve Chairman, towards the new paradigm has been more difficult to discern. Greenspan seems to have hedged his bets. When he observed irrational exuberance among investors in December 1996, the stock market fell 2.5%. On other occasions, he denied that the business cycle had been repealed and questioned whether stocks were not overpriced. Yet when asked to account for the long period of economic growth, Greenspan fell back on new paradigm explanations, claiming that information technology had enhanced the stability of business operations and that America was moving beyond history. Business Week concluded that the Fed chairman had become an avant-garde advocate of the new economy. Unlike his 1920s predecessors, Greenspan saw no need to stem the rise of speculation with either higher interest rates or stern warnings. As the guardian of the bull market, Greenspan's reappointment to office in 1996 was greeted with the same fervour as Treasury Secretary Mellon's in 1929. The most striking similarity between the 1920s and 1990s bull markets is the notion that traditional measures of stock valuation had become obsolete. Once again, it was argued that an investment in the stock market helped retain purchasing power during inflationary periods, and that management was becoming more responsive to shareholders' interests. Abby Joseph Cohen of Goldman Sachs claimed that a longer business cycle and lower inflation justified an upward valuation in stock prices. In their securities analysis, Benjamin Graham and David Dodds wrote that, instead of judging the market price by established standards of value, the new era of the 1920s based its standards of value upon the market price. In similar fashion, consultants in the 1990s invented a concept named market value added, which simply measured the difference between the market value of the firm and the amount of capital tied up in it. The higher the market value added, the greater the firm is deemed to be worth. The net asset value of a company, the value of its factories, machinery, and such like, became the most despised of traditional valuation tools. Dividend yields, which slipped to a historic low of less than 1.5%, were also dismissed as irrelevant. At times, even the price-earnings ratio, a measure favourable to speculative values, has looked too conservative. Discounting future cash flows was used to justify any price for fast-growing technology companies. In late October 1996, a headline in the Investor's Business Daily, a stock market daily which published relative strength figures, asked and answered a question that vexed many minds. Overvalued? Not if the stock keeps on rising. The new paradigm, or new economics, of the 1990s provided the intellectual underpinning for the greatest bull market in American history. When stock prices fell sharply in October 1997, Abby Joseph Cohen of Goldman Sachs saved the day by advising her clients to increase their holding of shares. James Grant has suggested that the reappearance of the New Era ideology was a sign that markets make opinions, not the other way round. In other words, the new paradigm ideology is simply a product of the bull market. As long as investors maintain their faith in a new era and ignore dissonant information, then stocks will continue to rise. In the short run, a rising market serves to cover up weaknesses in the economy. Consumers spend their stock market gains and ignore their rising debts. Companies issue new shares or bonds to purchase other companies or finance capital expenditure, and governments enjoy rising tax receipts as the economy prospers. In this way, the New Era analysis becomes something of a self-fulfilling prophecy. It has been estimated that between early 1990 and the spring of 1998, the rising US stock market boosted household wealth by around $6 trillion. Capital gains realized from the sale of shares reached $184 billion in 1997. Profits on investment have supported the growth of consumer expenditure, which has risen faster than wages and enabled the savings rate to decline until it turned negative in 1998. Rising receipts from capital gains tax, $44 billion in 1997, also helped to produce a federal budget surplus in 1998. Escalating share prices encouraged the establishment of new businesses and boosted capital expenditure. The stock market was hailed as the greatest wealth creator America has ever seen. According to one analyst, it had become a perpetual motion machine, an unconscious echo of the legendary bubble company of 1720, in which every share price rise generated further rises. Yet in the past, a point has always been reached where both speculation and credit arrive at the limits of their expansion. At that moment, the business cycle reappears with a vengeance, the perpetual motion machine begins rotating in another direction, and the new era is consigned to history. Chapter 8. Cowboy Capitalism, From Bretton Woods to Michael Milken. There is no way you can buck the market. Margaret Thatcher, 1988. The foundation of the post-war economic system was laid in the summer of 1944, when delegates of the Allied powers, the British Party led by Keynes himself, met at the Mount Washington Hotel in Bretton Woods, New Hampshire. Instead of reviving the old gold standard, they agreed that foreign currencies should be fixed in relation to the dollar, with the dollar convertible into gold at $35 an ounce. As the new system depended for its success on the control of capital movements between countries, it was marked by a deep antipathy towards the currency speculator. Echoing Roosevelt, the American Treasury Secretary Henry Morgenthau hoped that Bretton Woods would drive the usurious moneylenders from the temple of international finance. For the next 30 years, the speculator remained a figure of public obloquy, almost indistinguishable from the wartime black marketeer. In early 1946, after the market in grain futures was curtailed owing to shortages, President Truman declared that grain prices should not be subject to the greed of speculators who gamble on what may lie ahead of our commodity markets. Truman denounced grain speculators as merchants of human misery. Such sentiments were even shared by the young Mrs. Thatcher, who announced to the House of Commons during the 1961 budget debate, "It is the speculators in shares that we want to get at. The person who is making a business of buying and selling shares, not to hold them for their income-producing properties, but to live on the profit he makes from transactions." When governments found their formal currency arrangements disintegrating, the speculator became a convenient scapegoat for the failure of policy. Before the war, Hitler had blamed the inflation and deflation of the Weimar Republic on foreign currency speculators, while both Lenin and Stalin cursed speculators for the Soviet Union's economic woes. Now the leaders of the so-called free world joined in similar denunciations. During the Suez Crisis of 1956, the future Prime Minister Harold Wilson lashed out at speculating Swiss bankers, the little gnomes in Zurich, in his celebrated phrase. The gnomes had their revenge in 1967, forcing Wilson's Labour government to devalue sterling. 4 years later, when Nixon finally suspended the convertibility of the dollar into gold, thus bringing an end to the Bretton Woods system, he also condemned speculators. They thrive on crises. They help to create them. Even in the period of largely floating exchange rates since 1971, intemperate attacks on currency speculators by politicians have continued. When Britain was once again forced to devalue its currency and leave the exchange rate mechanism in September 1992, Lord Jenkins, a former Chancellor of the Exchequer, denounced the predatory packs of salivating speculators. to which the French finance minister Michel Sapin added that during the Revolution such people were known as agioteurs, and they were beheaded. During the Asian crisis of 1997, the Prime Minister of Malaysia, Dr. Mahathir Mohamad, described speculators as ferocious animals whose trade was unnecessary, unproductive, and totally immoral. In a more sinister fashion, he struck out personally at George Soros, the hedge fund manager, claiming that behind the speculators lay a Jewish agenda to return the developing nations to colonial status. The Malaysian government threatened to treat currency speculation as a capital offence, banned short sales on the Kuala Lumpur Stock Exchange, and later introduced currency controls. In part, the immediate post-war attacks on speculators and their trade reflected a profound change in the attitude to money-making and the pursuit of profit. In an essay entitled Economic Possibilities for Our Grandchildren, first published in 1930, Keynes imagined a world in which increasing prosperity and material security would finally do away with the profit motive. During the period of strong and stable growth enjoyed by Western economies in the 1950s, it appeared that this vision might be realized. In The Quest for Wealth, A History of Man's Acquisitiveness, published in 1956, Robert Heilbronner asserted that money-making in the current age was no longer esteemed. Opulence, the adulation of money-makers, and the wish for great wealth have given way, in part at least, to a new set of values, the camouflage of wealth, the contempt of mere money-makers, and even a certain disdain or disinterest in the goal of wealth itself. Heilbronner ascribed the anti-mammonism of the period to the experience of the Great Depression, which represented not merely an economic failure, but the bankruptcy of the philosophic foundation of an age. In the post-war world, the businessman was no longer flattered and admired as he had been in the 1920s. Instead, he became the dull, reliable, colourless figure satirized by Sloane Wilson as the man in the grey flannel suit. This change of style was accompanied by a shift in corporate priorities. Other goals, such as stability, continuity, and responsibility towards employees and the community, predominated over the simple profit motive. According to Heilbronner, the individual quest for wealth had been replaced by a corporate ideal in which individuals took only a small share of their corporation's earnings, enjoying instead the prestige and security of employment with an established company. In the 1950s, these changes appeared so self-evident and enduring that Heilbronner concluded his study by pondering whether the further accumulation of wealth in the near future might bring a new economic motivation to displace Adam Smith's invisible hand. The Financial Revolution. When President Nixon suspended the convertibility of the dollar into gold on the 15th of August 1971, he brought to an end the Bretton Woods system of the previous quarter of a century and ushered in a new era in the history of speculation. Although the first financial revolution of the late 17th century had seen the expansion of paper debt circulating as money, all values remained ultimately tethered to gold. Gold represented the antithesis of speculative values. Whenever speculation got out of hand and a financial crisis appeared, everyone sought refuge in the precious metal. Only John Law, the land bank projector and progenitor of the Mississippi bubble, realized that the value of all money, including gold, rested ultimately on a consensus. After Law introduced a paper currency into France in 1720, Lord Stair, the English ambassador to Paris, commenting on Law's recent conversion to Catholicism, undertaken so that he could assume the official post of Controller General of Finances, wrote, "There can be no doubt of Law's Catholicity, since he has proved transubstantiation by changing paper into money." For Stair and his contemporaries, Law's paper money was an act of faith, as bold as the belief in the miracle of the Eucharist. Finally, in 1971, a year that coincidentally marked the 300th anniversary of John Law's birth, his vision was at last realized. The transition from credo to credit was complete. At the end of the Bretton Woods system, money became only a figment of the imagination, weightless and ethereal. In this new world, where all monetary values were in flux, speculation, the self-adjustment of society to the probable, in Oliver Wendell Holmes' phrase, was destined to play a greater role. In the past, the suspension of gold convertibility had been associated with uncontrolled eruptions of speculation, for instance in France in 1720 and in the United States in the 1860s. During the turmoil surrounding the collapse of Bretton Woods, this was overlooked. Henceforth, all currency values would be a reflection of their perceived future values. The present would be as much determined by the future as the future by the present. And the grand arbiter of this confusing new system was the speculator. One person quick to grasp the significance of these events was Walter Wriston, the head of Citicorp, who declared that the information standard has replaced the gold standard as the basis of world finance. A new financial revolution necessary to accommodate this momentous change was facilitated by advances in information technology. From 1969, details of banks' bond trading was provided by the telerate machine, which became the electronic marketplace for U.S. Treasury bonds. 4 years later, the British news agency Reuters introduced its Monitor Money Rates service, which created an electronic 24-hour global marketplace for foreign currencies. Over the next few years, the computerization of financial markets continued apace. Most commentators viewed advances in information technology as a boon. If markets were inherently efficient, they would become even more so when supplied with better information. They might even become rather dull, like a reliable motor car. In fact, there is little historical evidence to suggest that improvements in communications create docile financial markets or better informed investment behavior. If anything, the opposite appears to be the case. In the past, the wider availability of financial information and improvements in communications have tended to attract impulsive new players to the speculative game. The first generation of daily newspapers stimulated the South Sea bubble. The new money market columns of the British newspapers contributed to the mining mania of 1825. Railways facilitated railway speculations in the 1840s, just as the ticker tape assisted stock market gambling in the Gilded Age, and radio programs in the 1920s excited a later generation of speculators. More recently, the Internet has brought the stock market into the home, where it has thrived. Mobile phones, handheld trading devices, and online brokerage accounts have enabled investors to trade from anywhere in the world. This had led to the appearance of hordes of day traders, amateur speculators who operate mostly from their homes, using their computers to access the cheap share-dealing services provided by online brokerages. They are called day traders because they close their positions at the end of each trading day. By the summer of 1998, 5 million Americans had accounts with Internet discount brokerages, and around 1 million of them were day traders. Average turnover on these online accounts was 12 times heavier than at conventional brokerages. Some traders reportedly carried out 1,000 trades a day. Because the Internet allows people to conceal their identity, the information revolution has generated an extraordinary amount of fraud, mostly of a low-level nature. Scattered across the World Wide Web are literally hundreds of thousands of get-rich-quick investment scams. Behind a veil of anonymity, crooked promoters pump and dump stocks through online investment forums. Perhaps more worrying than the appearance of fraud is the unsettling effect the Internet has had on investors' behavior. Described by its early advocates as an affinity group, the Internet has become a forum for herd-like speculation. Private traders spur each other on with messages posted on Internet bulletin boards. In some cases, online investors have developed unhealthy obsessions with individual stocks. Momentum investment, the mindless practice of buying and selling stocks as they rise and fall with the market, is said to be a sign of investors' reaction to information overload. Wall Street has joined with Silicon Valley to produce an investment argot for a virtual world. a world of momos, momentum stocks, P&D, pump and dump, head fakes, large traders creating the illusion of a stock movement, gapping up, stock rises sharply, scared money, desperate traders closing their positions at the end of the day, grinding, taking small profits from many trades, jiggles, volatile stocks, and noise, disagreement among traders. The cyber marketplace of the late 20th century, with its bashers, bears, and hipsters, bulls, closely resembles the coffee houses of Exchange Alley 3 centuries earlier, with their bubblers, sharpers, and cullies. The people and their practices remain the same, only the language and technology are new. The lack of a positive relationship between improved information and financial sagacity was most evident in Japan during the bubble economy of the 1980s, when a nation of information junkies, awash with financial data, nevertheless made some of the worst investment decisions in history. Nor is it clear that advances in communications have produced any improvement in the performance of professional investors. Speedier communications have created conditions for greater feedback and more trend following in the financial markets, which offset any improvement in the operational efficiency of the markets. Self-fulfilling currency crises, provoked by panicking traders, have become the norm of the 1990s. The speedier the communication, the faster the contagion spreads. The revival of the liberal economic ideology. Bretton Woods, Keynes's last significant achievement before his death in 1946, had failed for practical reasons. By the early 1970s, however, Keynesianism as a body of economic thought was also under sustained attack. For 2 decades, Milton Friedman, an economics professor at the University of Chicago, had been battling against Keynesian orthodoxy. Resurrecting the economic liberalism of the 19th century under the new guise of monetarism, he argued that the market was fundamentally a self-correcting mechanism, and that government attempts to interfere with its operation, whether by introducing price controls to curb inflation or by compelling management to influence the level of unemployment, were doomed to failure. In Free to Choose, a popular introduction to the free market ideology that Friedman wrote with his wife, Rose, he contended that all government intervention, however well-intentioned, had harmful side effects. For Friedman, markets were the best way to distribute information and provide incentives, regardless of the inequities that might emerge. In a 1973 interview with Playboy magazine, Friedman boldly asserted that all societies were structured on greed. The problem of social organization, he claimed, is how to set up an arrangement under which greed will do the least harm. Capitalism is that kind of system. Friedman not only defended the speculator against the charge of causing the Great Depression, he was also highly sympathetic to the speculator's economic role. This much-maligned figure sought out future economic developments and fed them through to the current prices, thereby preventing shortages and contributing to the efficient distribution of scarce resources. Like the insurer, the speculator was prepared to assume some of the inevitable risks of the capitalist process. If he was motivated by a desire for personal profit, so much the better. In an essay entitled In Defense of Destabilizing Speculation, published in 1960, Friedman claimed that speculation was castigated by economists because of a natural bias of the academic student against gambling. He suggested that speculation was unlikely to have harmful economic side effects, since so-called destabilizing speculators, who sold when prices were low and bought when they were high, would inevitably lose money, while the counterparties would gain at the speculator's expense. A process of social Darwinism would eventually eradicate the destabilizing speculator. For Friedman, speculation in the futures market was a zero-sum activity, which at worst supplied gaming activities to those who required the service. Friedman was the most prominent of a group of American academics whose work contributed to the revival of economic liberalism. The work of other economists, interested specifically in the operation of financial markets, joined together to form a new body of economic thought known as the Efficient Market Hypothesis, EMH. Exponents of the efficient market maintained that investors are rational agents seeking to optimize their wealth, and that stock prices move randomly, since at any moment they contain all information relevant to their price. That is to say, they are only moved by new information, which by its nature is random. While Friedman revived discarded nostrums, such as the quantity theory of money, the efficient marketers resurrected ideas concerning equilibrium in the financial markets that harked back to Adam Smith's assimilation of Newton's theory of equilibrium, the invisible hand being the analogue of the divine watchmaker, and to Leibniz's notion of the immanence of rationality in the world. During the 1970s, the efficient market hypothesis spread throughout American universities and business schools, while businesses and banks began applying financial techniques founded upon its assumptions. By the end of the decade, it had become the working ideology of financial capitalism, Holy Writ, in the words of Warren Buffett. The efficient market school of economists, many of whose members received Nobel Prizes, were highly sympathetic to speculators. If markets were efficient and in constant equilibrium, and if price movements were always random, then the activities of speculators could be neither irrational in motivation nor destabilizing in effect. Such a conclusion required the historiography of speculation to be rewritten, leading to a denial of the existence of irrational bubbles, and replacing them, as we have seen, with the tendentious notion of the rational bubble. While Friedman dismissed the idea that speculative excess caused the economic collapse of the 1930s, several economists of a historical bent attempted to show that the great speculative manias, such as the tulip mania and the South Sea bubble, were mere legends. Insofar as share prices rose during these periods, they argued, it was for very good reasons. Not everyone was convinced. As Warren Buffett pointed out, observing correctly that the market was frequently efficient, they, the efficient marketers, went on to conclude incorrectly that it was always efficient. The difference between the two propositions is night and day. Paradoxically, the widespread acceptance of the efficient market hypothesis may have served to make the markets less efficient. In the Panglossian world of efficient markets, investors were told that, theoretically, it was not possible to pay too much for financial assets. As a result, they were encouraged to bid up prices to unsustainable levels. The Derivatives Revolution. Out of this new age of paper money, economic liberalism, and information technology came forth a flowering of financial creativity as profound and far-reaching as the earlier financial revolution at the turn of the 18th century. Nowhere was this activity more in evidence than in the field of financial derivatives. As we have seen, a derivative is simply a security created by contract which derives its value from an underlying asset, such as a share or bond. In the form of futures and options on shares and commodities, derivatives are as old as capitalism itself. Because derivatives, such as share options, require smaller down payments, normally around 5% for a 3-month option, than the purchase of a real share, they were traditionally believed to encourage speculation. This prejudice was reflected in numerous government attempts to outlaw the derivatives trade, such as the Dutch ban on futures in 1609 and Sir John Barnard's Act, passed by the British Parliament in 1734. In the new era of economic liberalism, however, the old stigma was removed, and derivatives emerged at the forefront of financial innovation. In 1967, Milton Friedman attempted to bet against sterling prior to Britain's forced devaluation, but was turned down by the Chicago banks on the grounds that his action would encourage speculation. Afterwards, Friedman related his frustrating experience in print. His article attracted the attention of Leo Melamed, president of the Chicago Mercantile Exchange, known familiarly as the Merc, the smaller of the city's 2 agricultural futures markets. Given Friedman's consistent advocacy of laissez-faire, his defense of speculation, and his distrust of government regulation, it was not surprising that Melamed, a fanatical believer in free markets, should seek him out to assist with plans to create the most radical futures contract in history. After the collapse of Bretton Woods, Melamed approached Friedman and asked him to write a paper justifying the creation of a market for currency futures. The professor obliged, demanding a payment of $5,000 for his services. He is reported as saying, "I'm a capitalist, remember that." Friedman had long argued against capital controls in favor of floating exchange rates and the free movement of capital. In his paper for Melamed, entitled The Need for Futures Markets in Foreign Currencies, he claimed that currency futures would have a stabilizing effect on exchange rates and encourage the development of other financial activities in this country. Melamed's money was well spent. Permission was granted by the U.S. Treasury and Federal Reserve to establish the new international money market at the Merc, which opened in May 1972. The financial revolution had begun. Less than a year later, the Chicago Board of Trade opened a new exchange for trading share options. Other derivatives markets opened during this period included gold futures in 1975, Government National Mortgage Association Ginnie Mae futures in 1975, Treasury bond futures in 1976, crude oil futures in 1978, and currency options in 1982. In the past, a legal distinction had been made to distinguish the derivatives trade from mere gambling. It rested on the stipulation that the buyer and seller of a future must be able to contemplate actual delivery of the commodity at the end of the contract period. Gambling transactions, on the other hand, could only be settled with money. Yet in 1976, the Merc introduced a euro-dollar interest rate futures contract. Professor Friedman rang the bell on the opening day. This was a significant innovation, since it was impossible to deliver an interest rate. This undeliverable derivative, however, was legitimated retrospectively 5 years later, when a sympathetic head of the Commodity Futures Trading Commission, the federal regulatory body created in 1974 to oversee the derivatives markets, declared that contemplation of delivery was no longer necessary for futures transactions, and cash settlement was an acceptable alternative. This decision paved the way for the introduction of a plethora of index futures contracts at a number of exchanges. The first and most popular of the index futures, Standard & Poor's 500 index future, a more broadly based measure of the U.S. stock market than the Dow Jones Industrial Average, opened for trading at the Merc on the 21st of April 1982. Within a year, the nominal value of S&P futures traded in Chicago exceeded the turnover on the New York Stock Exchange. Around the same time, the Chicago Board of Trade introduced options on futures, a derivative of derivatives. This financial revolution was given further impetus in the early 1980s, when Sidney Homer, a brilliant bond specialist employed by Salomon Brothers, the investment bank, devised the idea of separating, stripping in technical language, bonds from their dividends, and selling the two securities separately. This breakthrough enabled banks to turn a variety of previously illiquid assets into tradable securities, a process known as securitization. Homer's insight was applied to the enormous U.S. federally guaranteed mortgage market and led to the creation of synthetic mortgage bonds, in which interest and principal payments were stripped and sold as separate bonds. The PO, principal-only bonds, were divided into several tranches with different repayment priorities. The final tranche, called Z-bonds because they were the last to repay the principal, were highly volatile and known as toxic waste by the traders who handled them. They have been described as among the most speculative instruments ever offered to American investors. Salomon Brothers invented many other new financial products in this period, including cars, collateralized automobile receivables, spins, low-coupon debt securities which paid back on the rise and fall of the S&P index, and the gloriously named Heaven and Hell warrant, a security whose payments varied under different circumstances. In 1981, Salomon Brothers also arranged the first debt swap between the World Bank and IBM, which was followed by the rapid growth of the international swaps market. Financial innovation continued into the 1980s with a multitude of new financial instruments: negotiable floating-rate notes, income warrants, puttable bonds, butterfly swaps, currency swaps, floor-ceiling swaps, interest rate swaps, swaptions, synthetic equity, synthetic cash, and zero-coupon bonds. The offshore Eurobond market in London was a fount of creativity with its foreign bonds, shoguns, sushis, down-unders, kiwis, and so on, zero-coupon convertibles, dual-currency yen bonds, and countless warrants bonds. By the end of 1996, the size of outstanding derivatives contracts was estimated at around $50 trillion, although since most of the derivatives trade was conducted away from the exchanges in the over-the-counter market, no one was sure of the figure. The derivatives world lost none of its creativity in the 1990s. Rocket scientists, or quants, at investment banks were kept busy devising increasingly exotic financial instruments, such as discrete payoff bull notes, principal exchange rate linked security, and prime LIBOR inverse floating rate notes. The new derivatives are explained in an arcane language of forward yield curves, option-adjusted spreads, duration, and negative convexity. Few people, apart from their creators, understand either the language or how the financial instruments functioned. Opinions differ as to whether the proliferation of new financial instruments stimulated speculation. Professor Merton Miller, the Nobel laureate who took a seat on the board of the Chicago Mercantile Exchange, maintains that derivatives are essentially industrial raw materials, created to cope with uncertainty and financial volatility after the end of Bretton Woods and the 1974 oil crisis. One man's insurance, however, might be another man's speculation. If a derivative position is hedged, that is, when its risk is offset either by ownership of the underlying security, such as a share, or by a normal business risk, such as a foreign currency exposure, then it is insurance against potential loss. However, if the position is unhedged, then it is highly speculative. Anecdotal evidence suggested that players were not slow to exploit the opportunities for super-leveraged speculation offered by the new derivatives markets. This conclusion appears to be borne out by recent experience. Of the series of great derivatives disasters in the middle of the 1990s, only one, that of Metallgesellschaft, loss $1.5 billion, has been caused by the mishandling of bona fide hedging transactions. The others, Barings, loss £850 million, Orange County, loss $1.7 billion, and Sumitomo, loss $2.6 billion, have been the result of unhedged and unauthorized speculation. Nick Leeson, a 27-year-old plasterer's son, displayed the speculators' traditional disdain for hierarchy by bringing down the Queen's Bank, Baring Brothers, in February 1995. He did so by selling options and futures in the Singapore futures market, which created a total exposure of $18 billion, many times Baring's capital base. The escalating losses that caused the bank's failure came with a suddenness that only derivatives can produce. Several other high-profile cases of derivatives losses at American corporations appear to have been caused by a combination of aggressive pushing of derivatives by investment banks and speculative risk-taking by corporate treasurers. When Procter & Gamble sued Bankers Trust to recover derivatives losses of $102 million incurred in 1994, it produced a recorded transcript of a Bankers Trust derivatives salesman stating that he aimed to lure people into the calm and then just totally fuck 'em. Professor Miller dismisses these derivatives scandals as inconsequential management failures. The Reagan Revolution. The full potential of the financial revolution was realized only when the political conditions were right. It took the better part of the 1970s for the revived free market ideology to feed through from American universities to the political world. Milton Friedman, very much a political economist, played a key role in the process. In the 1960s he advised Republican presidential candidates, including Richard Nixon. Later he briefed Ronald Reagan, who as president showed off his economic proficiency by using his hands to draw charts of the money supply in the air. During the 1970s, Friedman visited Britain frequently, where his ideas were taken up by Mrs. Thatcher, then leader of the Conservative opposition. By the end of the decade, he was the best-known economist in the world. He had received the Nobel Prize in 1976, his face had graced the cover of Time, and he had presented a 10-hour television documentary on his views. On both sides of the Atlantic, Margaret Thatcher, elected in April 1979, and Ronald Reagan, elected in November 1980, were poised to put Freeman's economic philosophy in practice. A powerful alliance had emerged between economic liberals and Reagan Republicans. Both agreed that government intervention in economic affairs was undesirable, and that the judgment of the market was paramount. Throughout Reagan's administration there was a profound, dogmatic distrust of regulation, which was seen as merely another malevolent aspect of big government. One of the first acts of Reagan's Justice Department was to drop the 10-year antitrust action against IBM. The regulatory structure of the 1930s, which had been designed to act as a counterweight to speculative excesses, was now allowed to decline. The Glass-Steagall separation of investment and commercial banking was not rigorously enforced, the Securities and Exchange Commission's budget was reduced, and regulators everywhere were expected to be infused with the spirit of the free market and deregulation. Influenced by free market economists such as Friedman and Arthur Laffer, Reagan rejected the Keynesian antipathy towards profit and actively encouraged the pursuit of self-interest. "What I want to see above all," he announced, "is that this remains a country where someone can always get rich." As in the 1920s, income and corporation taxes were reduced, and the role of the entrepreneur was exalted. In the summer of 1981, Reagan broke the air traffic controllers' strike, ushering in an era of weak unions, declining real wages, and growing inequalities of wealth. While Reagan expressed the desire to create a nation where someone could become rich, what his laissez-faire policies actually created was one in which the financial operator could become wealthy beyond his wildest dreams. The rest of the population was promised an elusive trickle-down of wealth, as the rich spent the money they saved on taxes, and new fortunes were expended on the consumption of luxuries. The rise of the trader. The 1970s were a decade of chronic financial instability. Floating currencies, rising inflation, stop-go economic policies, and declining growth rates produced unwelcome volatility that made the stock market a dangerous place for investors. The Nifty 50 boom of 1972, during which no price was deemed too high to pay for America's leading companies, was followed by a steep market decline. During a period of low growth and high inflation, stagflation, stocks did not arouse the speculative interest of the public. Although the Dow Jones Industrial Average had breached 1,000 in February 1966, by the spring of 1980 it was below 800. Faced with uncertainty, most private investors preferred to play it safe and enjoy the high interest rates paid on money market funds. Those with a greater appetite for risk were able to speculate in commodities and precious metals, which offered the best hedge against the chronic inflation of the period. One person who availed herself of this opportunity was the wife of the governor of Arkansas, Hillary Rodham Clinton. In late 1978, the future First Lady embarked on a brief career as a speculator. Trading in cattle futures, soya beans, and live hogs, Mrs. Clinton turned an initial $1,000 stake into $100,000 10 months later, at which point she retired from the game. The derivatives contracts into which he entered during this period were extremely risky, carrying an underlying value of over $3 million, which was roughly 30 times the net wealth of the Clinton household. The most remarkable aspect of this speculative foray, however, is that Mrs. Clinton achieved phenomenal success despite the fact that most of her trades were on the short side at a time when cattle prices doubled. Mrs. Clinton was not the only person looking to make a quick buck in the volatile commodities markets. In January 1979, after the Soviet invasion of Afghanistan, the price of gold rose to $875 an ounce. 6 months later, Nelson Bunker Hunt and William Herbert Hunt, the sons of the Texas oil billionaire H. L. Hunt, together with several wealthy Arabs, formed a silver pool. In a short period, they amassed more than 200 million ounces of silver, equivalent to half the world's deliverable supply. The price of silver rose nearly tenfold, peaking at over $50. Once the silver market was cornered, outsiders joined the chase, but a combination of changed trading rules on the New York metals market, COMEX, and the intervention of the Federal Reserve lanced the bubble. The price of silver fell back to $10 in March 1980, bringing losses of over $1 billion and eventual bankruptcy to the Hunt brothers. During the silver bubble, an official at the Peruvian Ministry of Commerce, who was employed to hedge his country's silver production, lost $80 million by illicitly selling silver short. Although a relatively small sum for a sovereign nation, it was an omen. The rogue trader had appeared on the modern financial scene. A number of institutional factors contributed to the rise of the professional market trader. During the 1970s, several leading U.S. investment banks, including Morgan Stanley, went public. Rather than cautious partners with unlimited liability and limited capital, these banks now had greater capital resources and answered to anonymous shareholders. Institutionalized speculation, known as proprietary trading, became an appealing route to quick profits and large bonuses. Proprietary trading became even more attractive after May Day 1975, when fixed commissions were abolished on the New York Stock Exchange. The rapid growth of securitization, the process of turning illiquid assets into tradable securities, further enhanced the role of the trader-salesman. By the early 1980s, traders were running Wall Street. John Goodfriend, the cigar-chomping son of a wholesale butcher, had risen from being a lowly municipal bond trader to become head of Salomon Brothers. Robert Rubin, the head of risk arbitrage at Goldman Sachs, became the firm's senior partner and later Treasury Secretary under President Clinton, following in the steps of Salomon's legendary trader William E. Simon, Nixon's Treasury Secretary. Another trader, the foul-mouthed Lou Glucksman, was appointed chief executive of Lehman Brothers, the prestigious White Shoe investment bank. His brief and disastrous tenure at Lehman ended with the firm being taken over by American Express. The two most influential financiers of the 1980s, Louis Ranieri of Salomon Brothers, who built the collateralized mortgage business into a $1 trillion market, and Michael Milken, Drexel Burnham Lambert's junk bond guru, were both traders by training and inclination. The trader also flourished outside the world of investment banking. Advances in communications encouraged the growth of hedge funds, private investment partnerships which evaded the SEC's regulation. The most successful of these, the Quantum Fund, founded in 1973 by the Hungarian-born financier George Soros, produced average annual returns in excess of 25% from its leveraged positions in a variety of stock, bond, and currency markets. Alongside the hedge funds, risk arbitrage investment partnerships appeared in the 1970s. Highly leveraged like the hedge funds, they looked to profit from the sharp price movements associated with corporate takeovers. One of the most high-profile of the risk arbitrageurs was Ivan F. Boesky, the son of a Detroit bar owner, who set up his own partnership in 1975. Egotistical, short-tempered, and flashy, the trader became a symbol of the 1980s. The master of the universe in Tom Wolfe's The Bonfire of the Vanities, and The Big Swinging Dick of Michael Lewis's Liar's Poker. The title of the book alluded to an alleged $1 million game of liar's poker between Goodfriend and John Merriweather, Salomon Brothers' chief trader. The trader was an international phenomenon, a product of deregulation and globalization. In London, young traders employed by rapidly expanding American investment banks at the time of the Big Bang, the deregulation of the London Stock Exchange in 1986, earned six-figure bonuses. They were caricatured in the press as Porsche-driving barrow boys and satirized in Carol Churchill's play Serious Money. In pursuit of ever larger bonuses, traders introduced a frenzied, brutal quality into the world of finance. Aggressive became a synonym for ambitious in the curriculum vitae of the young banker, and The Art of War, a martial classic by Sun Tzu, the Chinese Clausewitz, became fashionable reading in financial circles. The trader's language was couched in violent metaphors. At Salomon Brothers, salesmen boasted of ripping the faces off their clients. Capital no longer moved at a sedate pace. It whirled with the mesmerizing speed of a roulette wheel, and the trader had to keep up with it. In such an atmosphere there was no time to pause. "Lunch is for wimps," declared Gordon Gekko, the anti-hero of Oliver Stone's film Wall Street. Possibly no man worked longer hours than Michael Milken, head of Drexel Burnham Lambert's Beverly Hills Bond Department. Sleeping only 3 or 4 hours a night, Milken arrived at work before 4 o'clock in the morning in order to catch the opening of the market in New York, and handled up to 1,000 transactions a day. While Milken ascetically avoided all stimulants except money, Ivan Boesky bolstered himself with endless cups of coffee to sustain his grueling 21-hour day. Hard work, a product of the trader culture, came to replace play as the motif of the super-rich. Gone was the extravagant idleness of the privileged, described in Thorstein Veblen's The Theory of the Leisure Class. The new symbols of wealth in the 1980s, private jets for the wealthy, mobile phones for the less affluent, exemplified not repose but ceaseless striving. In the era of global 24-hour trading, money didn't sleep, nor did those who pursued it. The rise of Michael Milken. By the early 1980s, the popular lessons of the Great Depression had worn thin. Under the influence of Reagan, business was once again venerated. Debt was perceived as tax-efficient rather than imprudent. In the capital markets, deregulation was replacing supervision. The individualistic pursuit of wealth had displaced the communal goals of full employment and equality of distribution. Yet for the first 18 months of Reagan's presidency, the bond and stock markets remained depressed as interest rates were raised to record levels in order to squeeze inflation out of the system. Commercial interest rates peaked at over 20%, and the yield on long-term bonds climbed to over 15%. Finally, in the summer of 1982, the chairman of the Federal Reserve, Paul Volcker, reduced the discount rate. The battle against inflation was now over. Half a century after the stock market nadir of 1932, the market began to rise. While Mrs. Thatcher pioneered the privatization of state-owned public corporations by floating them on the stock market, President Reagan witnessed privatizations in his country of a rather different nature. They involved taking public companies, those quoted in the stock market, and putting them back into private hands. The purpose of the leveraged buyout, or LBO, was to acquire a company with the maximum amount of debt. The interest and principal on the LBO debt was to be paid off as quickly as possible with the cash flow generated by the company. Once the leverage had reached a conventional level, the company was normally put up for sale or refloated on the stock market. The potential of this type of transaction was first set before the public in the summer of 1983, with the flotation of Gibson greetings cards. 18 months earlier, former Treasury Secretary William Simon, together with a partner, had purchased Gibson for $1 million in equity and $79 million of debt. Yet when the company was offered in the stock market, its market capitalization was $290 million, and Simon's modest personal investment of $330,000 had turned into a fortune of over $66 million. The beauty of the deal lay in its timing. Simon had purchased the company when the stock market was in the doldrums, and sold it when interest rates were declining and the market had revived. Falling interest rates and rising asset prices were not the only factors working in favour of LBOs. The fiscal system was conducive to leverage, since corporate interest payments were tax-deductible, whereas dividend payments were not. This tendency was reinforced in 1981, when the Reagan administration persuaded Congress to pass the economic recovery tax, allowing companies to accelerate depreciation charges, thereby reducing their tax bills and enabling them to take on more debt. Although the Federal Reserve prevented speculators from buying shares on a margin of more than 50%, there were no restrictions on the amount of leverage applied in a buyout. The participant in a leveraged buyout had several other advantages over the margin speculator. His interest payments were tax-deductible, he was not subject to margin calls, that is, asked to provide more collateral when asset values fluctuated, nor was he personally responsible for the LBO debt, which was packaged as bonds and sold on to other investors. If the company went bankrupt, he could walk away with little loss, but if the deal was a success, his gains were outlandish. Although he was the son of an accountant, Michael Milken of Drexel Burnham Lambert preached a message heretical to accountants' ears. He advocated turning the balance sheets of companies upside down, replacing shareholders' capital with debt. Milken was employed by Drexel in 1970 as a trader in high-yield or junk bonds, loan securities which paid a higher rate of interest because their issuer's credit rating was low. He challenged the conventional wisdom that high-yield bonds were speculative in the sense of being more risky. This message was derived from an analysis which showed that the bonds of lowly rated companies, or fallen angels, as Milken called them, offered good investment opportunities, since high yields more than compensated for their historical rate of default. Investing in a portfolio of speculative bonds, he claimed, would produce better returns over the long run than a portfolio of AAA-rated debt issued by the likes of General Motors. Having successfully sold this idea since the early 1970s, Milken looked for new applications for his junk bonds. His first idea was to use them as venture capital for fast-growing businesses, such as Ted Turner's cable news network and McCaw Cellular, a mobile phone operator, along with a number of Las Vegas casino businesses. As Milken came to dominate both the primary, that is, issuing, and secondary trading markets for high-yield bonds, a visionary side to his junk bond philosophy revealed itself. He claimed that he was able to distinguish between popular perception and reality. Bond rating agencies such as Moody's, he complained, looked to the past rather than the future. People and industries of the future are considered risky. Junk bond users are the industries of the future. At other times, his vision was less exalted. Defending his bonds, he declared, "Everything we like is junk. Junk food, junk clothes, junk records. Everything that stands the test of time is junk." Milken's instinctive salesmanship was as brilliant as his financial mind, which retained an encyclopedic knowledge of companies' financial histories and market information. Had he confined his activities to the existing market in low-grade corporate bonds, supplemented with the issue of bonds for high-risk ventures, it is unlikely that his name would ever have attracted attention outside his professional field. Out of the mergers and acquisitions department of Drexel Burnham Lambert, however, came the idea of using high-yield bonds to finance leveraged takeovers of American public companies. In August 1984, Milken and Drexel made their first move into the field of hostile takeovers, backing T. Boone Pickens, the Texas oil tycoon and head of Mesa Petroleum, in his attempt to gain control of the giant Gulf Oil. Without actually having the funds necessary for the takeover, Drexel produced a letter stating it was highly confident of raising the capital through the sale of junk bonds. Although this bid failed, the highly confident letter symbolized Drexel's ability to finance deals of limitless size. The bank's first successful hostile bid came in April 1985, when a Milken-backed raider, Nelson Peltz, acquired National Can in a $465 million deal involving leverage of 11 parts debt to 1 part equity. A few months later, Drexel client Ron Perelman captured Revlon, the cosmetics firm, in the largest hostile LBO to date. More successes soon followed. In April 1986, Kohlberg Kravis Roberts, an investment partnership specializing in LBOs, raised over $6 billion through Drexel to take control of Beatrice, a conglomerate whose interests ranged from Samsonite suitcases to Avis car rental. Milken and his corporate raiders relished their position as outsiders to the corporate world. At the 1985 Drexel High Yield Conference, otherwise known as the Predators' Ball, the bank's chief executive, Fred Joseph, declared triumphantly that, "For the first time in history, we've leveled the playing field. The small can go after the big." In the manner of Jay Gould, the raiders applied a rhetoric of public service to their activities. They claimed that incumbent management, or corpocracy as they styled it, was inefficient and only concerned with its own security and the perquisites of office. Nelson Peltz went so far as to argue that American management was more communist than the Russians. More bluntly, Sir James Goldsmith declared, "Takeovers are for the public good, but that's not why I do it. I do it for the money." Yet the raiders' claim that they were promoting the democratization of capital was hollow. At Milken's junk bond feast, there was no vacant cover for the uninvited guest. Milken pursued his operations through a clique whose membership was far more exclusive than the so-called establishment. Junk bonds were issued for a small number of corporate raiders and sold to a small number of institutional investors. The group was so closely connected that it was nicknamed the Daisy Chain. From his X-shaped trading desk in Beverly Hills, Milken commanded the financial and corporate worlds. He was revered by clients and associates. He only cared about bringing the truth. If Mike hadn't gone into the securities business, he could have led a religious revival movement, claimed a former Drexel executive. Another colleague asserted that Michael is the most important individual who has lived in this century. Contemporary descriptions of Milken as a messiah preaching a junk bond gospel abound. As Milken's power waxed, he began proselytizing on non-financial issues, rambling about the prospects of housing the world's population on floating hotels, lecturing his visitors on the risks of tampering with food packages, and pondering on human longevity. Yet there was a crude, bullying quality to the Drexel organization, which gave the outfit more the air of a mafia family than a religious cult. Fierce turf wars were fought with other investment banks. Since Milken controlled around 2/3 of the junk bond market, no one could afford to alienate him, and companies which didn't play ball might find one of Milken's raiders, or even Drexel itself, appearing suddenly on its shareholder register with a potential hostile holding. By 1986, Drexel had stakes in over 150 companies and owned a junk bond portfolio worth several $100 million. This gave Milken even greater power in his ceaseless quest to dominate the junk bond market. An anonymous colleague told Connie Brooke, author of The Predator's Ball, "Michael is interested in power, dominance, 100% market share. Nothing is good enough for Michael. He is the most unhappy person I know. He never has enough. He drives people by insult. He drives everything. More deals." Although Milken had little interest in flaunting wealth, he had an insatiable desire to accumulate it. In addition to being a talented creative genius, said one Drexel employee, Michael is one of the most avaricious, ruthless, venal people on the face of the earth. In the early 1970s, Milken had negotiated a generous compensation deal with Drexel, giving him the right to retain $1 of every 3 he made for the firm. Hostile LBOs generated fees running into tens of millions of dollars for Drexel. Milken supplemented his Drexel income by running a number of private investment partnerships, which participated in the more lucrative deals. On occasion, when clients issued bonds during a takeover, Milken demanded warrants, options to buy shares, as a sweetener. Instead of being distributed to the purchasers of junk bonds, these warrants were handed out to favoured clients or retained by Milken's private partnerships and by Drexel. "If we can't make money from our friends, who can we make it from?" Milken is reported as saying. In January 1986, Milken interviewed Martin Siegel, a leading mergers and acquisitions advisor, for a job at Drexel. "If people here know how rich they are," he told Siegel, "they'll get slow and fat. You must never count your money. You have to keep driving yourself to make more." In 1986, Milken kept $550 million of the junk bond department's $700 million bonus, making him the highest-paid individual in American history. Sometimes the wealth amassed by Milken's raiders was even greater. Ron Perelman, the Revlon raider, was reputed to have turned a loan of $2 million in the late 1970s into a fortune of nearly $3 billion a decade later. Although costs were cut after buyouts and management was pruned, corporate extravagance persisted. The former chief executive of Revlon, Michel Bergerac, observed that although much had been made of his supposed extravagance during the takeover, the new management under Perelman was, if anything, more luxurious. "These so-called raiders," complained Bergerac, "managed to get hold of one of these large companies, and a mysterious process of osmosis seems to take place. They go to London to get their suits, they hire French chefs, they drink French wine. One plane is not enough for them, and some of them have 2 or 3 planes. So all I can say is that either the demands of the job create these things, or that the good life is contagious." Flushed with their newfound wealth, the junk bond gillionaires, as one writer called them, and their bonus-laden financial advisers put on a show of wealth without parallel in post-war America. President Reagan's glitzy $6 million inauguration in January 1981 set the tone for a decade in which conspicuous consumption became a sign of the vitality of the American dream. Lavish parties were held at New York's cultural monuments. The Metropolitan Museum of Art, Club Met to one gossip columnist, was decorated with 12,000 Dutch tulips and 50,000 French roses to celebrate the marriage between the children of corporate raider Saul Steinberg and Larry Tisch, head of the Lowe's Corporation, a baronial extravagance on the scale of Castile and Aragon in the 15th century, cooed Vanity Fair's editor Tina Brown. For a while, Susan Goodfriend, the wife of Salomon Brothers' boss, led Nouvelle Society. Whether redecorating her Fifth Avenue apartment at a reputed cost of $20 million, booking 2 seats on the Concorde to fly a cake to Paris for her husband's 60th birthday, or sending out invitations styled "at home" to a party at Blenheim Palace, the extravagances of Social Susie became the talk of the town. The former air hostess amused the world with her gaucheries. "Bonsoir, madame," curtsied the native Texan on being introduced to the First Lady. "It's like living in a fairy tale," she told the New York Times. The value of the good friend's invitations, remarked Michael Lewis in Liar's Poker, seemed to rise and fall with Salomon Brothers' share price. "It's so expensive to be rich," she lamented a few weeks after the Wall Street crash. As power shifted from the bankers to their clients, John Goodfriend was usurped as King of Wall Street by Henry Kravis. The title was bestowed by Businessweek magazine. In society, Susan Goodfriend ceded place to Kravis's fashion designer wife, Caroline Rome. The second Mrs. Kravis was a tall and skinny Midwesterner, the definitive social X-ray, a type diagnosed by Tom Wolfe as suffering from anorexia riciosa. Her activities were followed insatiably by gossip columnists. Bent on self-improvement, she studied French in France and opera in Salzburg. She took up the piano and announced that she was a reincarnation of Brahms. While many of her husband's employees laboured longer hours for lower wages to pay off the debts incurred by his leveraged buyouts, Rome announced to the press that she worked like a slave, designing dresses embroidered with precious stones, A press release stated she was crazy about diamonds. A party she gave at the Metropolitan Museum was described by one guest as Medi Shishi. The diminutive Kravis, according to his wife, he is quite tall when he stands on his wallet, affected a patrician air. At his Manhattan office he lunched off the finest Wedgwood china, had his shoes buffed while seated behind his mahogany desk, and one day was visited by Princess Margaret, who dropped in to admire a painting by Stubbs. An air of unreality hung over these inhabitants of Nouvelle Society. "Beauty and glamour are a state of mind," announced Caroline Rome's publicity material. Her husband might well have said the same of stock market values. The boom in leveraged buyouts became the driving force behind the bull market of the mid-1980s. Conventional measures of value gave way to LBO valuations, known as private market value, which were calculated by examining how much cash, free cash flow, a company generated and how much debt it could support. Professional risk arbitrageurs, on the lookout for the next takeover, became the medium through which private market value was established in the stock market. Acting in unofficial collusion, arbitrageurs searched for vulnerable companies and took large stakes in them, thus putting them in play. Members of the public followed the ARB's operations and imitated them, just as their forebears had followed stock market pools in the 1920s. Because the arbitrageurs and their followers had no loyalty to the company whose shares they owned, their activities made life simpler for the corporate raiders. When a bid was publicly announced, the raiders' broker needed only to call round members of the arbitrage club to acquire control of a company. This process, known as a street sweep, was most dramatically displayed in Robert Campo's takeover of Allied Stores, when, with a single telephone call, a Los Angeles broker named Boyd Jeffries acquired 32 million shares, or more than half the shares in circulation, giving Campo control of the $4 billion company. ARBs risked losing large sums of money when they took a stake in a company if a bid was not forthcoming or fell through. For example, when Gulf Oil's bid for Cities services collapsed in May 1982, Ivan Boesky lost $24 million. Apparently, it was this loss that drove Boesky to build a secret network of investment bankers, which included Martin Siegel of Kidder Peabody and Dennis Levine of Drexel. Using inside information supplied by Siegel, Boesky made $28 million from Nestlé's acquisition of Carnation in 1984. Boesky was not the only one who wished to play the game with loaded dice. A Business Week study in the spring of 1985 showed that nearly three-quarters of takeover bids were anticipated by strong advances in share prices, a sure sign of insider trading. With his average annual investment returns of over 80%, Boesky was widely suspected of basing his speculations on insider information. On the 18th of May 1986, Boesky addressed an assembly at a California business school with words that defined the 1980s zeitgeist. "Greed is all right, by the way," he announced to whoops of delight from the attendant yuppies. "I think greed is healthy. You can be greedy and still feel good about yourself." This speech was not so much a call to arms as Boesky's perverse valediction to a life spent in pursuit of mammon. For by the time he uttered his celebrated words, Boesky knew his time was up. 6 days earlier, his chief informant, Dennis Levine, had been arrested on charges of insider trading in New York. On the 14th of November 1986, the Securities and Exchange Commission announced that Wall Street's most notorious arbitrageur had confessed to insider trading offences and was cooperating with investigators. 3 days after Boesky Day, the Wall Street Journal announced that Milken's role in the affair was under investigation. In reaction, the Dow Jones fell 43 points, junk bonds dipped sharply, and Ron Perelman abandoned his bid for Gillette. Although the game was not yet over, it had begun to turn. The market soon forgot the insider trading scandals. In January, President Reagan delivered an ebullient State of the Union address that caught the mood of the nation. "The calendar can't measure America," because we were meant to be an endless experiment in freedom, with no limit to our reaches, no boundaries to what we can do, no end point to our hopes. In sympathy with the notion of limitless aspirations, the Dow broke through the 2,000 mark for the first time. It continued upwards, despite a sharp fall in late January 1987, which brought a warning from the SEC chairman of an impending first-class catastrophe. Around the world, a speculative froth was evident. In London, Saatchi & Saatchi, an advertising group best known for its services on behalf of the Conservative Party, launched an abortive bid for the Midland Bank, one of the country's largest commercial banks. A financial Hitler arrives on Wall Street. In America, mergers and buyouts rebounded after Boesky Day. Milken and Drexel faced growing competition from other Wall Street banks, eager to muscle in on their LBO franchise. The world of junk bonds and hostile takeovers took on the attributes of a game, expressed in an esoteric ludic language. A target company was said to be in play. If a white knight did not come to its rescue, management could thwart the predator with a poison pill or a Pac-Man defense, which involved making a counterbid for the predator. And if all this failed, the chief executive could bail out with a golden parachute compensation package. A banker proposing a deal talked of teeing up the concept. A high bid was a hat trick, and a successful junk bond issue a home run. The banker was rewarded with a small, plastic-encased tombstone advertisement recording details of the completed transaction. It was known as a deal toy. In the words of a Drexel executive, this was Disneyland for adults. As the competition increased, the quality of the deals declined. Symptomatic of this development was the elevation of Robert Campeau, a Canadian property developer, to the rank of successful corporate raider. Campeau was a prize eccentric whose business success had been accompanied by increasing grandiosity, vanity, and quirkiness. He maintained 2 separate families, took elocution lessons, had his teeth capped, his face lifted, and his hair transplanted. A hypochondriac, he flew regularly to Germany for injections of sheep brains, and travelled everywhere with large supplies of mineral water and fresh oranges. His unusual appearance was enhanced by a penchant for wearing pork-pie hats with feathers sticking out. In New York, Campeau would call his bankers in the middle of the night and hold meetings with them in his hotel room dressed only in a pair of underpants. At one meeting, Campeau emphasized a point by picking up a fork and stabbing it through the tabletop. In fact, Campeau was a manic depressive, given to throwing tantrums and delivering stream-of-consciousness tirades. At such moments, his eyes, the one part of his physiognomy untouched by the surgeon's knife, would bulge out of his head and his hands would shake. The Canadian business establishment rightly viewed Campeau with suspicion and blocked his attempted takeover of a large financial institution at the beginning of the decade. In the giddy atmosphere of the 1980s, Wall Street was less fastidious. In 1986, Campeau came to New York, where he took a suite at the Waldorf Astoria, equipped himself with a lawyer from a prominent Wall Street partnership, and started looking for an acquisition. After much thrashing around, he finally set his sights on the department store sector. He decided to bid for Allied Stores, owner inter alia of Brooks Brothers, the preppy clothing store. Allied had sales of $4 billion, 70,000 employees, and a market capitalization of $2 billion, over 10 times that of the Campeau Corporation. Campeau's advisors, led by Bruce Wasserstein, first Boston's star dealmaker, were unfazed either by the disparity in size between predator and victim or by their clients' lack of experience in retailing, although Campeau talked vaguely of a synergy between real estate and retailing. Instead, First Boston offered to lend the aspiring department store magnate